Hey, welcome. So today, we're going to build a toolkit for your financial future. But instead of hammers and wrenches, we're talking about the tools of investing, the things that can make your money work for you. Ready to get started? Let's dive in.
Take a second and really let that question sink in. You work hard for your money, right? But is your money working hard for you in return? Or is it just kind of sitting there? Investing is all about putting that money to work, letting it grow even when you're sleeping. That's the whole idea.
So here's our game plan. First, we'll cover the big question: what even is investing? Then we'll get into the two main tools, stocks and bonds, and how to combine them with funds. After that, we get to the really cool part, the magic of compounding. And we'll wrap it all up with the most important strategy of all, balancing risk and reward.
All right, first things first, we have to lay the foundation. Before we start grabbing all these shiny tools, we need to understand why we're even building this thing. So what does it actually mean to invest?
Okay, that sounds a little textbooky, but here's the core idea. Instead of spending your money right now, you're putting it to work. You're basically telling your money, hey, go out there and make more money. It's a huge shift from just stashing cash away to actively trying to grow it for your future self.
Okay, let's crack open that toolkit. Right on top, you're going to find the two most essential tools for pretty much any investor: stocks and bonds. Now, they work in totally different ways, but together, they're the bedrock of most investment strategies.
So, what's a stock? Think of it like this. You're buying a tiny, tiny slice of a company. You become a part owner. And that's pretty cool, because if the company does well, the value of your little slice can go way up. But, and this is a big but, it also means you're taking on risk. If the company struggles, the value of your slice can go down too.
So, how does owning that slice actually put money in your pocket? Well, there are two main ways. First up, dividends. That's when a company is doing really well and decides to share some of its profits directly with its owners. That's you. The second way is what most people think of: capital gains. You just sell your stock for more than you originally paid for it. Simple as that.
And now for our second tool, the bond. If a stock makes you an owner, a bond makes you a lender. You're basically giving a loan, an IOU, to a company or even the government. And in return for that loan, they promise to pay you back your original money on a specific date, plus interest along the way. It's usually a much more stable, predictable investment than a stock.
And every single bond is really defined by just three key things. First, the coupon rate. That's just the interest rate you get paid. Second, the maturity. That's the date you get your initial loan back. And third, the par value. That's the amount they repay you on that maturity date. You understand those three things, you understand the bond.
So let's just put them side by side for a second. Stocks mean ownership. That comes with higher risk, but also the shot at a much higher reward. Bonds mean you're making a loan, much lower risk and a much more predictable, steady return. See? Two different tools for two totally different jobs.
Okay, so we've got our two basic tools, but what if you don't want to spend all your time picking out individual stocks and bonds? And what if you want to spread your risk out without a ton of effort? Well, that's where funds come in. This is all about strength in numbers.
This is where that whole pooling idea is so powerful. A mutual fund basically takes money from thousands of different people, bundles it all together into one giant pile, and then a professional manager invests that money across a huge variety of stocks and bonds. Think about it. With just one single purchase, you can instantly own a tiny piece of hundreds of different companies. It is, by far, the easiest way to diversify and spread out your risk.
So we have our tools, and we've got a smart way to combine them. But what's the thing that makes them truly powerful over time? This next part, this is the engine that drives everything. Some people have called it the eighth wonder of the world, and honestly, for good reason. It's the magic of compounding.
To really get the magic here, we need to understand the difference between two kinds of interest. Simple interest is, well, it's simple. You only earn interest on the money you first put in. But compound interest, oh, this is where it gets exciting. You earn interest on your initial amount, plus you earn interest on all the interest you've already made. It's literally interest on your interest.
Let's use a real example, because that makes it so much clearer. Let's say you start out with a nice round $10,000. That's our starting amount, our principal.
Okay, now, if you earn 5% simple interest on that money for 5 years, you get $500 each year. So after 5 years, that's an extra $2,500. Your total is $12,500. Not bad, right? But now, watch what happens with compounding. Same $10,000, same 5% rate, same 5 years.
But this time that interest starts earning its own interest, and it creates this amazing snowball effect. And look at that. You end up with over $12,800. That's more than $300 extra, and you didn't have to do a single thing differently.
And when you see them next to each other like this, that gap between the two bars, that is the power of compounding. And here's the key. The longer you let it work, the bigger and bigger that gap gets. Time is the secret fuel for this engine.
Okay, so we've got the tools and we've got the engine, but how do we actually use them wisely? This last part is all about strategy. It's the fundamental principle that should guide every single investment decision you make.
This right here is probably the most important rule in all of investing. I'll say it again, the higher the potential return, the riskier the investment. Period. There is no free lunch. Understanding this trade-off is absolutely crucial if you want to build a portfolio that lets you sleep at night.
So how do you manage that risk? Well, the #1 strategy by a mile is diversification. You've heard it a million times, don't put all your eggs in one basket. By spreading your money out across lots of different investments, just like we saw with that mutual fund, you make sure that if one area has a bad day, it doesn't sink your entire ship.
And that kind of brings us full circle. We've looked at the tools, the strategies, and that incredible engine of compounding. But the most valuable asset you have, the one thing that really makes compounding work its magic, it isn't your money. It's your time. So the real question is, what are you going to do with it?